Welcome back to Morning Trade Live. We got futures doing okay right now. Solid second half of last week as bulls' hopes running high as we head into the second half of big tech earnings this week. Jay Pelosky joins us, founder and global strategist at TPW Advisor from the New York Stock Exchange at the Schwab Network desk. Jay, good morning. After a blackout period, we get some intel from the Fed this week too. Let's start there. What are you expecting as the messaging from the FOMC?
I think, Oliver, it's going to be, we're on course and we're continuing to stay on course, watching the data, looking for continued signs of disinflation that will allow for rate cuts to, gradually unfold over the second half of the year, first half of next year. So we don't expect much of a change. We're really not very focused on the Fed. We don't think the Fed is the real driver of things here. We think it's economic growth. We think it's corporate earnings. We think it's some of the things going on in China, in commodities. Really not all that focused on the Fed at this point.
I'm glad that you say that because I was going to describe your framework that you've laid out with us before. And correct me if I'm wrong, even though I believe you guys do think that eventually the Fed will be able to loosen up, that hasn't been the primary reason for kind of the optimistic and bull case, right? It's more earnings, and I know a lot of it is international as well, kind of a comeback story there too.
Absolutely. I've got a good memory, Oliver, and I appreciate that. But definitely, we've been focused on economic growth being better than expected, which leads to corporate earnings growth being better than expected, and reminding ourselves and our clients that it's earnings that drive stocks, not GDP growth, earnings growth. And look, for the U.S., double-digit earnings growth for each of the next 3 years, 2024, 2025, and 2026. That's a really supportive backdrop for stocks. And then you have the opportunity set internationally where the rest of the world is starting to pick up its growth path. The U.S. has been the leader. Going forward, we expect to see Europe recover, China to continue to grow, and see real opportunities in emerging markets and commodities.
On the margin, U.S. versus rest of world, does rest of world get a little bit even more appealing if we don't get a accommodative, soft touch Federal Reserve with a bunch of cuts, Jay?
I think that's a real interesting question, right? You got to kind of feather the brake a little bit. The U.S. has been really the place to be, really, since the great financial crisis. So it's been a long time. But we're setting up for what we think is going to be a turn in the dollar environment that could really unleash the rest of the world. And in the interim, we're very focused on what we call the two tech stack divide between the U.S. and China, where both countries are kind of ring fencing their tech space. And you talked about it earlier before the break, what's going on in China and what makes Tesla's news so interesting. Why Apple has been weak is because it's not performing very well in China. So we've actually been playing the China tech stocks as the opportunity here. And over the last couple months, China tech has considerably outperformed U.S. tech. And that's a story that doesn't get told often enough in our view.
We're on the same page again. I literally last week was tweeting, I think it's one of the most underappreciated stories that while our momentum kind of got hit, the Chinese momentum picked up. You're getting higher highs, higher lows in the China ETFs over the last 3 weeks. Copper's been breaking out. A lot of people tie that commodity to China, so it seems the pieces kind of come together there, Jay. How do you play it? When you look at the Chinese market, what's kind of the best way to dabble there, after a rough 18 months where it seemed like nothing worked?
Oh, it's absolutely been a rough period, Oliver. And look, the signal or the tell was a couple months ago, right, when people were talking about China as uninvestable, right? And so pro tip, when you hear uninvestable, you should buy. So look, here's a couple of little data points that really resonated with us over the last week. One was that China foreign buying of Chinese equities hit a record on Friday. $3 billion of foreign buying in just one day. The second point that really struck out was at the IMF meetings last week. Surveys are done about where people are allocated. Only 3% of those surveyed at the IMF meetings were overweight Chinese equities. And so to us, there's a real opportunity. It exists primarily in the tech stack. So we really like KWEB. We're ETF focused here at TPW Advisory. So we really like KWEB, which is the China Tech ETF. It's breaking out. Those stocks sell at significant discounts to the US peers. E-commerce market in China is twice the size of that in the US, growing at 15% per annum. And the lead stock there, Alibaba, as an example, trades at 8 times earnings, Oliver. 8 times earnings. I mean, US tech is not trading anywhere close to 8 times earnings.
It literally is like another world in terms of valuation.
Absolutely.
So now if China is kind of back on its feet, Jay, and that's a strong case for the Chinese market as a whole, does it possibly also create some buy the dip potential for Apple and Tesla, which have been, I think, the most sensitive to Chinese slowness in the big cap world here at home?
That's a great question, Oliver. I mean, we're seeing it with Tesla today on Good News. I wonder if this is not a little bit of an olive branch by the Chinese government to the U.S. Let's remember, Secretary of State Blinken was in China last week, as well as Elon Musk over the weekend. And let's see what happens with Apple. I mean, China for Tesla, that's an isolated issue, so they can control that. Apple, I think, is really certainly is being challenged in China because it's a consumer story, and here the consumer story is Huawei and other Chinese companies that are producing models, smartphones that are more attractive to the Chinese market than Apple. So let's see. I mean, for us at the moment, we really like the risk reward in China tech versus the US tech. In the US tech space, we're focused on the semis because we are big believers in the AI age and that investment cycle, which we heard about last week from Alphabet and Microsoft. Semis are going to continue to benefit from that. So we own SMH as our main play in US tech.
Tell me about the trade-off that we saw last week, Jay. I'm curious your thought on the way the market punished Meta and then rewarded NVIDIA. I mean, I guess in some ways it makes sense, in others it doesn't, and maybe it is concerning for the messaging on Meta valuations or other AI services valuations. I mean, what's the problem in spending if you're spending on what apparently the market says is the hot new trend, AI? If we're going to punish companies for doing that, have we maxed out the rally?
Well, I don't think we've maxed out the rally in the semis at all, Oliver. I mean, to me, one of the big takeaways was that both Alphabet and Microsoft talked about spending $40 to $50 billion on AI. And that's primarily on semiconductors. So that's why, in our view, NVIDIA had that big pop. And so it's had a nice pullback, which is a feature, not a bug. Had a huge move, nice healthy pullback, and now starting to move again. And so for us, we like that idea of buying the picks and shovels of the AI age. And that is the semiconductor space. And so we like semis in the United States. We like China tech because it's being walled off from the US tech companies. We like the commodity space because we think we're seeing global growth pick up. There's a supply and demand imbalance there, thinking about copper, thinking about uranium, thinking about energy. So we are very heavily weighted in commodities, overweight equities, and very underweight US treasuries.
All right. I like it. The pieces fit together. Your framework is consistent across the board. Logic adds up with the case being made here for some of the China tech. A nice spin on it to update for us, Jay, over the last couple of weeks. Appreciate the catch up. Thank you very much.
Thank you, Oliver. Always great to be with you and always fun to be on the floor here trying to hear you over the cheers of the crowd.
I know. Well, to be honest, I kind of had one more in the tank for you, but it's about to get real loud, so we're going to let you jump. We'll keep the conversation going for next month. Thanks, Jay Pelosky, founder, global strategist at TPW Advisory. All right, a little bull case in commodities there, too, from Jay, worked into the China bull case. and appreciating tech's strength with a lot of hope for semiconductors, but not appreciating the bond market, as Jay seems to be avoiding the treasuries.